Hi guys, welcome back. It's Chris with you again from JC Trading. Today I wanted to make a comprehensive video regarding the inverse fair value gap strategy that we trade in our Discord server. This was a video that has been requested by one of the members. Unfortunately, Storm Bert is ravaging the UK at the moment, and I thought what better time to sit down and make a video because it's blowing a gale and it's absolutely torrential rain. So here we are. I'm going to go through everything that you need to know about the inverse fair value gap, the indicator that we use, how we trade it, why we get into trades and why we exit trades. So the very first thing is, what is a fair value gap? And it's an imbalance between three candles. I've got one marked up here. That is a 1 minute fair value gap. Now, if we notice that it's comprised of three candles. This candle here is number 1. This candle here is number 2. That candle there is number 3. Now, if you look, the gap between number 3's wick, which is just there, and the body of candle number 1, there is a gap. Now, that is a fair value gap. It's an imbalance. It goes by many names, but fair value gap is often the most common name. So that is a fair value gap. They happen on all multiple time frames. You'll notice here I've got a 2M fair value gap there. So if I was to flick over onto the 2 minute, we would see that there would be an imbalance here between that wick and that candle body. So it has to be 3 candles. We'll stick to the 1 minute for the time being. So we know what a fair value gap is. It's an imbalance between 3 candles, and it's the gap between candle number 1 and candle number 3. So how do we identify them? That part's relatively easy. We use an indicator. And the indicator that we use for it is iFVG Nephew Sam. So this is the indicator. If you go up into and click on indicators here, type in iFVG, you'll see this one there, or type in iFVG open bracket nephew underscore Sam underscore close bracket. You'll definitely find it. Now, the time frames that we use are 1 through 5 minutes. So we want to know about every fair value gap that's either on the 1, 2, 3, 4 or 5 minute time frames. So I have these 5 boxes ticked. I've selected 1 minute, 2 minute, 3 minute, 4 minute, 5 minute. The labels, you can call them anything you like. So you could call that just 1M, you could call it 2M, it's entirely up to you. The important things that you need to be aware of on this indicator are wait for candle close to identify fair value gap. This just means that the third candle has to have closed before it will show you the fair value gap on the screen. The filled fair value gap type is close. Delete boxes after fill, you want that ticked, otherwise you'll just end up with a sea of fair value gaps on your chart. Hide fair value gaps lower than enabled timeframes. Now I've got my max bar set to 902, so it will look at the last 902 candles and display the fair value gaps for them. Length of boxes is 10. That's just how far they extend over to the right. Obviously, you could make that 100 if you wanted, 50, and make them longer or even shorter. You could put that down to 2 or 3. The colours are entirely optional. I've got green for bullish, red for bearish. Label position is where the label is positioned within the box. So you can see one in the background there. It's positioned to the right of the box. Label size is medium. Self-explanatory. Obviously, you can choose whatever you like. The label color I've got down as black, but again, you could change that. Dashed border width 1, black and black. These down here are all optional. The ones that are really important are wait for candle close to identify fair value gap and delete boxes after fill, hide FVGs lower than enabled timeframes. So that's the indicator that we use. They're the settings that we have for the indicator. So what's it going to put on your chart? Well, in simple terms, if I scroll out here a little bit, you're going to see lots of green boxes in this instance. If we go over here, there's some red boxes and some red boxes up there. Anything green is bullish, anything red is bearish. So why do we have all these green boxes and all these time frames? Simply put, if you don't want to have to keep going through every time frame for your particular instrument trying to identify fair value gaps, which is what you would have to do, this indicator is a must. I can see at a glance here that I've got a 1 minute there, I've got a 2 minute, I've got a 1 minute, I've got a 3 minute, a 3 minute. This is auto updating. I'm not needing to do anything. People try and rely on their eye for this, and I don't know why you would, seriously, because it's human error will always creep in. And if you're not regularly going through every single one of these, looking for fair value gaps, marking them up, going back to the 1 minute, going through them again, looking for fair value gaps, marking them up, this is changing on a minute by minute basis. I don't see why you would want to do that when this will automatically populate a 3 minute when the 3 minute candle closes. So I can see at a glance what I have on the chart from 1 minute through to 5 minute, and I'm trading the 1 minute chart. That's all I need. I don't need anything more. I don't need high time frames. I certainly don't want to be flicking through time frames every minute to find out if a new fair value gap has been formed or not. So that's why we use it. And I suppose now is how do we use it? We've discussed the indicator, why we use it, how do we use it. So if we go over onto NQ, there are a couple of things that we're looking for an inverse setup. The first thing is we have to have some form of liquidity been taken. Now, in this instance, this little move down here actually swept a range low, a previous range low. That may have been a London low, an Asia low, New York low, but it's swept a low. So we've taken liquidity. So we've got a tick in the box. We can't have any equal lows in this instance for a long. We can't have equal lows here if we want to go long, because there's a very good chance the market will go up, do a 180, come down, take that liquidity, and then come up. The other things that we couldn't have below, for argument's sake, are a news low. So if we've got, excuse me, just go back here. Oh, I've just kicked my keyboard and brought up an alternate symbol. Apologies for that. Right. Now I need to go back and find the trade. Oh, apologies for that. I've put my keyboard down by my foot so that I didn't need it on my desk to give me some more desk space. These were these are two fantastic silver bullets we took last week, by the way. I'm going to do a separate video on those. This again was another inverse setup. I'm going to do a separate video on that, I think, because it was slightly different to our normal rules. But as you can see, really good trade. Apologies for this. Sorry, I should have put my keyboard out of the way so it wasn't near my foot. Okay, sorry, right, we're back. Sorry about that. Okay, so we've had a sweep of liquidity, which was here. We can't take this long if we've got a draw on liquidity below. Now that might be equal lows or it might be a news low. There wasn't either in this instance. The second thing is obviously we need to inverse the fair value gap, which we've done. This grey candle there that's come up, that inversed the fair value gap. Ideally, we like a singular fair value gap as well. So in this little leg down here, there is only one fair value gap, and that was one 1 minute fair value gap. Now that could be 1 2 minute or it could be 1 3 minute, depends on your trading plan. I personally prefer a singular 1 minute fair value gap. This is what we had in this instance here. You also need a minimum of a 1-to-1 hour trade before you get to your next area of liquidity. So in this instance, our next area of liquidity is there. And if I was to bring this down to here, that's a 1 to 2.2 hour trade. So we didn't have any draws on liquidity. We've had a sweep. We've had a singular fair value gap. In this instance, it was a 1 minute. We've inversed and we've got a minimum of a 1-to-1 R to our next area of liquidity. This trade we actually closed on, I think it was around this high here. The reason we closed here was we were targeting up here, but the market come up, then it immediately come back down again. It then come back up again. Then it was clearly finding resistance at this area. So we got out of this trade just up here, but the actual trade itself isn't what I'm trying to show you. It's more the fact of trading fair value gaps. So we've now ascertained why we use an indicator, because we don't want to be flicking through 5 different time frames every minute to find out if there's a new fair value gap. We know what a fair value gap is, and that's obviously the gap between 3 candles. So in this instance here, in fact, actually, this may have been a 2-minute. I think this was a 2-minute. It was a 2-minute. Apologies. This was a singular 2-minute fair value gap. So, but as long as it's singular, that's the main thing. If you had lots and lots of them, obviously this isn't going to work, because you're going to be going immediately into your next area of liquidity, which would be, say, here, where your next fair value gap was, and you wouldn't have that 1-to-1R. So we know why we use an indicator. We don't flick through the time frames. We know what a fair value gap is, and that's the gap between 3 candles. We know what we're looking for, and those are a liquidity sweep, which we've had in this instance here. It took a previous range low. Now, it doesn't have to be a range low. It can be any liquidity. You could come up here and say, right, well, we've just swept this lower high now. Now we're looking for a trade to the downside. So potentially, if there was a singular 1 minute there and it met all of your rules again, you could have got a trade to the downside as well. With regards to targets 1-to-1, we do let trades run typically, unless we can see obvious price action where it's being rejected from a particular level. But this one up here, for argument's sake, this was a slightly different trade. This was a retest trade, and I was targeting this range low, news low. I think there was a news low down here. So that was a 1-to-60R trade, this one here. We'd come up, swept liquidity. There was a news low around here and a range low, I think, from memory. I think that was the news low there. So once we come up here, swept liquidity, we then broke structure. This was a retest trade of this fair value gap here. So we come up, tapped into that. Once we got to that low there, I was break even. Put a line on. Nothing's working today. Put a line on there. Once we hit that, I was break even. I then was targeting, I think it was a range low down here. Basically, I was waiting for price to go against me, so structure. And I believe there was either a news low or a range low down here. I think it was possibly a range low, because we got this short down here. We got out at the range low. That was obviously then a sweep of the range low, and then we were then given this long as well. So we ended up with 2 almost back-to-back trades there. This one here was a 60R, and that one was a 1-to-4, and that was using the inversion. So typically we trade the inversion and the silver bullet over in our Discord server. But obviously today is purely about the inverse fair value gap strategy. So hopefully that's answered your questions about what a fair value gap is, why you need an indicator, the indicator we use, the settings, what we're looking for, the rules, and everything from start to finish pretty much that you're going to need. There is no doubt in my mind you can get funded using this. There's no doubt in my mind you can become very profitable trading this. We're trading 2 sessions live every day over on our server. Links in the bio, by the way. London and New York. We're trading inverse and silver bullet, as I said, and it's extremely profitable. Extremely profitable. If you're looking for someone to mentor you, or you just want to watch us trade, possibly just learn more about the strategies, pop over. But that is the inverse fair value gap in a nutshell. Hopefully it's answered all of your questions. If it hasn't, please leave them below or pop over to the server and I'll be happy to answer them. Thanks for watching, and I'll see you soon. Cheers, bye.